Welcome to the Tip Wealth Builders podcast, where we bring you insights, strategies, and stories to help you compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. So whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. Welcome to another session of Tip Wealth Builders. Today we're addressing something that's on everyone's mind: market volatility. With headlines often painting a grim picture, it's easy to feel uncertain. But at Tip, we take a different approach. We'll discuss why our methodology gives us confidence, even in turbulent times, and what our outlook is for the future. Joining me today are Tip Group's CEO, Andrew Coleman, Head of Funds Management and Education, Sanjee Narendren, and Corporate Advisor, Pete Hasrouni. Each of them brings a wealth of experience and unique perspective to the table, and I can't wait for you to hear their insights. Welcome back, gentlemen, to our next episode. I'd like to hit on a topic today in regards to volatility. It's something that we're seeing happening in the market right now. The market's jumping all over the place, doesn't know whether it's up or down, and we're hearing a lot of noise through the media, through everywhere you can think of. We're getting opinions, everything. So what's going on?
Well, I think the words of Shakespeare are so apt, right? Around the empty vessel with a lot of sound and fury signifying nothing. But taking aside any comments about American politics, which could get us into another hours-long podcast on its own, I think what we're seeing really play out is just another period of many throughout history where the rules of the world order are being questioned.
Right.
And markets being driven by business people making, in theory, long-term investment decisions, don't like being left with that uncertainty. Whether that's going in the end to create huge upheaval, positively or negatively, I have my views and I've written on that, so we won't go into that today. But I think what we can expect is that until the world order and the world markets continue to understand or work out through this noise what's actually happening, the volatility is going to shoot through the roof. And as you say, the market's going to bounce around like a bit of jumping beans, up, down, sideways, depending on the day. What's interesting, though, of course, is if you ask two separate questions. The first is that good for the world economy? And the answer, of course, is no. Volatile markets are not good for the world economy because it bleeds into real-world decision-making. How do you make a long-term investment decision, a hiring decision, a decision to open a new market when you're unsure where things are going to go or what your cost of finance is going to be, or even whether you'll be allowed to operate in that market or not if Trump or Lutnick get their views more widely held? But the second question, and the one that's probably more relevant for the majority of people listening to this podcast, is what does that mean for your wealth? And how can you play that? And of course, that's a very different question, because unlike for the business person or the politician where volatility is a problem because it creates real world economic impacts, for an investor, volatility is your friend. In fact, the best friend you can have, because it's the equivalent of having a bipolar business partner who walks into your office one day and says, the world is ending. I hate my life. I don't care. Just pay me $1 and I'm gone. You can have my share. And the next day walks in and says, it's back to happy days. What would you like for your share? I'll pay it anything you want. And you very, very rarely, it's about once a decade, get these opportunities as an investor where incredible assets are available at steep discounts for very short periods of time before they revert to a more meaningful valuation. And similarly, where you have the opportunity to get out of maybe some assets that you didn't wish you were holding at prices that have spiked well beyond any rational actor would have originally offered you for. We get these through history. I mean, some famous examples, of course, of bubbles and crashes of things like the tulip bubble in Amsterdam, the South Sea bubble in England, the Poseidon nickel experiment here in Australia in the 1960s. But they come about roughly once a decade, and we were about due for one. So we shouldn't be surprised it's occurring. I think the cause of why this one is occurring is a little different and a little weirder. And Pete, you and I have had a number of conversations, Sanjee, as we have as well, around the self-inflicted nature of this volatility as opposed to it being something that was a natural occurrence in the economic cycle. But they come about once every 10, 15 years. And the last time we had one, of course, was roughly 2014 in Australia, 2008 in the United States. So, this is nothing out of the ordinary. Other than the perhaps extraordinary comments from the White House that have triggered it.
And this is a different way to think about it. Like, this is very different than what I'm hearing and reading in the newspapers and coming through the media, that this is actually an opportunity as opposed to a, oh my goodness, the world is ending.
Well, the classic problem is that the average financial analyst, and I mean this with great respect to them, but the average financial analyst's career is less than 5 years. It's a demanding job, and it doesn't tend to encourage longevity. And so if your entire career in the market has been 2 years, 3 years, 4 years, 5 years, even 8 years, have you lived through a period of volatility as a market participant? Probably not. And the market's not designed to encourage you to stay in it that long. You know, our joke is that the average long-term investor considers themselves a long-term investor because they look 6 months ahead. I mean, that's not long-term, that's short-term. You wouldn't do anything in life call that long-term. You know, if you're a really long-term investor, so you're thinking 10, 20, 30, 40 years ahead, volatility is just a blip on the graph, and we get them all the time. But if you're a market participant, a day trader, an options investor, a tick and flick type of fund manager, you know, dealing with index funds that have to rebalance themselves once a quarter, this kind of volatility can feel very shocking, very new, and very scary, because you either weren't around when it last happened, or the last time it happened was so long ago it's well outside of living memory. For those of us a little older, one would hope a little wiser, but not necessarily. But those who sort of think longer term and have been in the markets for a long term, this is normal. What's not normal is the cause. You know, I think the last time we were in a world where we decided that the laws of economics didn't apply was probably the late 1960s, early 1970s, and it didn't end very well there either. There's that lovely quote of, "You may not believe in gravity, but gravity believes in you." But I think, you know, Pete, from your points of view, and Sanjee, because you're dealing with clients on a day-to-day basis who are experiencing this volatility, what's the advice you give them? Because, I mean, I can say from my high horse all I want that, you know, volatility is an opportunity, it's not the enemy. But when you're living in that cycle, that's not necessarily easy to internalize. So what kind of advice do you give, and what are you seeing out there at the moment?
Thanks, Andrew. I think from my perspective, the first call is absolutely that it is short-term noise. So always look to fundamentals, even when there's less volatility. They matter irrespective. True facts. I think, you know, if I can quote Alain de Botton, you know, one's doing quite well as they mature if they become better at accepting the existential maxim, this too shall pass. So if you're looking at a long-term investment strategy, of course the volatility shall pass. I think when I reflect on some of the distress perhaps caused by volatility, looking to try to help clients understand the true underlying fundamentals of the challenge. Just use, for example, you know, will I or will I not reshore manufacturing in the US? Well, did it make sense before? No, then perhaps it won't make sense in the long run. You know, well, we're not looking to go to high cost countries to do things because of a temporary change in a market or an index or a tariff or any of those transitory elements. We're looking underlying, is this a long-term sound business decision? So when I reflect on the conversations we have with clients, it's about, you know, what is it we want to achieve over 5 to 10 years? And how would we set about achieving those things? And then that tends to eliminate some of this background of, will it be 5%? Will it be, okay, so in the long run, a 5% tariff shouldn't fundamentally affect a business decision or not. And likewise, what is it that, how do you compete and how defensible is that competitive decision? And again, if a little bit of volatility ruins your competitive advantage, how durable was your competitive advantage? So the stand back about business fundamentals, what is it? Yeah, what is it we do? How do we do it? Into which markets? You know, the traditional considerations for success. Is the market in structural growth? You know, can you compete and sustain that? Do you see a real risk of entrance or disruption? And then, you know, what stores do you have in reserve to weather times like this? And that, as a kind of a stand back, you know, eagle eye view of the competitive set, is very important, because it can be easy to get caught up in the noise. It's in the way perhaps only they know how. it's quite furious and fast, and it's it's sound bites, and it's the world's bond markets are doing this, and the Dow's doing, and the Nasdaq's. But I think if you step back and to Andrew's point, and I know Sanjee will speak about it, is having sadly showing my age survived a number of these. I mean, I was in the building products industry pre-GST. And you would have thought the world was going to end, that there would never be another stick of timber processed in Australia, and just everybody had to get some. So in the end, we found ourselves with a ridiculous notion of prices rising 40% to beat a 10% GST. That weathered poorly, right? And then, of course, you had this enormous hangover post that change when people realised, okay, I've baked that in. And, that was my earliest experience in my career of how we can make poor decisions in volatile times. But likewise, that time was a perfect opportunity to sit on your hands until July 1 and then cash in, right? Because all of that supply's there now. There's a terrible hangover of supply in the market. And, okay, it's 10% more expensive than it was technically, notionally on June 30, but it's actually 30% cheaper than it was. And I think, that was an excellent early lesson for me in, particularly the wisdom of factfulness and demystifying, I think, because sometimes, and I think ever as the technology and complexity of how we communicate information grows, it can be too easy to just simply be over, it's the choice paradox, right? If there's too many things to look between, we can become paralyzed by the number of choices. So to stand back and say, what are the true choices? What is it that I'm really choosing between? And what is the intrinsic express value of each of those choices? And then that's how we choose.
Yeah, you've made some really excellent points, Pete. I mean, one of the earlier points you were talking about is really we need to cut out all of the noise and just look at the fundamentals of the business. You don't go into business for a short-term, quick win, quick gain, which is why we look at a company. When we look to invest in a company, we'd be looking at a company from a 5 to 10 year, and preferably a 10-year view, to see that the company is going to build a sustainable business that can continue its growth and continue its runway, because these quick gains, they come and they go. And in my experience in broking, and mind you, I started just before, about a year or so before the GFC hit. So at that time, every bar you'd go to, every taxi you'd get in, someone was spruiking something in the market, and they had some sort of insider knowledge, or they had some sort of knowledge of something, which is similar to what we've been hearing recently as well, that, just invest in this and invest in that. And every time somebody found out that I was a stockbroker, they wanted to tell me some stocks, and they'd ask me some sort of tips and, what do you know? But rather than trying to look for these short-term gains, you can just sit back, find a steady business which allows you to take on much less risk and disregard the volatility. And it's easy to say disregard volatility when there's so much noise. It's a scary move. But once you've made that change, you realize this is not so scary at all. I sleep so much better at night when I can disregard the volatility and actually rely on facts and rely on what I know about my investments.
And I think just on that point, what's really important there is, if you are invested in assets, businesses or otherwise, that have incredibly strong fundamental underlying businesses. So you followed a research-driven approach, for example, to remove companies that have one or more signs of being a potential capital killer, things like too high debt or unstable earnings or negative earnings. Then you can sit through a period of volatility very calm and very happy, because you know that not only are your assets protected, but they're likely to be beneficiaries as their competitors suffer or make rash decisions in a panic. Unfortunately, the corollary to that is if you have invested in or work in a business that is not at that stage of stability, it's either itself a startup or very highly volatile by its nature, or it's commodity driven where prices are set by others, not by you, or you have very high debt, or you have fundamental issues in the market you're playing in that are being disrupted by the underlying cause of the volatility. Perhaps, for example, you are a major recipient of US government funding in the moment and you're worried about where that's coming. Then unfortunately everything we've said is a little bit trite, because you are actually in the period where you have to make massive decisions now, because that's not volatility, that's a step change in the operations of your business. Yeah. And I think that's really the important thing to talk about. You know, we talk about from an investing perspective, we can stay calm and look through the cycle. But that's because we've already done the work to exclude those that are likely to get impacted by any form of volatility, whether it's tariff driven or otherwise. But that's not a luxury that everyone can have. And it's certainly a luxury that's afforded more to an investor than a business person. Absolutely. Because, of course, an investor can say, well, this business is a little volatile, I'm going to get out of it. A business person or a CEO can't just say, well, I'm done, thanks, goodbye, right? You know, you've got to work through the challenge. An investor can leave the luxury of that disruption to the paid management to do it. And so I think really in any time of volatility or otherwise, but particularly in a time of volatility, it's worth identifying which of the spectrum are you in. Are you in the safe, stable, and I don't mean safe, defensible or anything. I just mean a stable business with strong competitive advantages that doesn't have a stakeholder that can pull the plug on you like a bank tomorrow, or a government, one large customer that can pull the terms, in which case volatility is your friend and you should be looking at this as an opportunity. On the other hand, if you're on the other side of the equation, someone that really could be materially impacted by something like this, your funding comes from one customer, your business is in an early stage and going through lots of upheavals where an extra piece of noise can be really damaging, then you've really got to do a bit of work right now to understand what is the chart that I am going to sail through in these choppy waters. And if you don't do that now, in 6 months' time, it's going to be too late. As that saying always goes, you know, the best time to make a decision was yesterday. The next best time is today. And so I think that's a really interesting question when you look at your own portfolio or you look at your own business, is to firstly understand, have you done the pre-work in the lead up to any element of volatility? Because you can't tell when the market will be volatile. It just Absolutely. Becomes volatile, right? Yep. So you have to do that work in advance. Have you done that work in advance to identify which of those two elements you fit into? And then if you have, what are the strategies available to you? And a really good exercise that's useful is just to run the thought experiment and say, you know, let's say that this is a new world of a changed environment in trade and countries are going to throw up tariffs on each other like they did in Smoot-Hawley in the 1930s. Well, that's a really easy scenario to role play, which sounds really hard, but you can say, well, what if there was a 20% tariff on all my goods or all of this company's goods? What would happen to my company? Yeah. Or my investment, and don't try and be overly analytical. Just ask 0, no damage; 1, some damage; 2, it'd be severely damaging; 3, I wouldn't have a business or I wouldn't have an asset, and just do it like that. And any of those that come up with, or any parts of your business or your assets that come up with scores of 2 or above, they're the ones that need your attention now. Anything that comes up with a 0 or a 1, what you're really saying is, with a benefit of a little bit of thought, this is just noise for this business. You know, if it's going to be no damage or positive or only a very small amount of damage, that's not something to be worried about. There's probably bigger risks you have in your everyday operations than that. On the other hand, if it scores highly in your mind, a 2 or a 3, that's where you need to be maybe engaging either with your team or with experts to identify the appropriate path to either minimize that risk or find alternatives if the risk triggers.
Yeah, and so when you do that, go to that second order of thinking as well. So it's not just, oh, will a tariff come and impact the business and will the company have to be subject to tariffs paying it? Look a bit deeper. Are they in a market where people will pay the tariff regardless? Are they price makers or price takers? What about their competitors? Is everyone going to be subject to a tariff? Maybe they're in a lower tariff jurisdiction than somebody else.
Yeah.
So think about it at a few levels deeper to think, okay, if everyone's going to get a tariff slapped on it, what's going to be the problem?
Yeah, I mean, if everyone gets the same tariff, has anything changed? The only thing that's changed is the American consumer has to pay more and the American economy will contract. But if the tariff is the same on everyone, then what change in competitive landscape has it caused? On the other hand, I mean, we're very offended, being a long-standing American ally, that we've been hit with a 10% tariff.
Yeah.
But if our competitors in the product that you're selling come from parts of the world that have been hit with 20, 30, 40, 50% tariffs, isn't this not a negative, but a positive for you? You've now just gained a massive competitive advantage over your competitors without having to invest in product development. You know, normally if you want a competitive advantage, that's a requirement for investment or R&D. Here, the American government has given you a free kick, at least in certain parts of the world. And similarly, if you're not selling into the United States, does it matter at all? You know, if your trade is between Australia and New Zealand, has the tariff affected you? Is it likely to affect you? Well, only if there's a second or third order flow-on effect. So you can be a little calmer and a little more rational when you look from the bird's eye eagle eye, I think, as you put it, which I quite liked, particularly given the American eagle may be the one plummeting right now, I mean, with a wing clipped or two. But you know, when you take that 40,000-foot view and look back on it, the decisions aren't that difficult, and they're no different to any other period of volatility. And, you know, in the last few years, this is actually not the biggest period of volatility we've had. Yeah. This may end up being the biggest long-term damage, but it's only 5 years ago that the world shut down for COVID. Yeah. And I think not only did the volatility indexes spike more and the share markets move more and the bond markets move more, but I think from a real-world economic impact or personal impact, COVID probably affected all of us significantly more than any tariff tantrums will out of Trump and Lutnick.
How quickly we forget, right?
And how quickly did we get through it?
That's right.
That's it.
And I think COVID may be one that's fresh in our minds. But if you look at the PE ratios over history and the ASX, and you follow that, it was just post-COVID that PE ratio spiked like nothing the market's ever seen before. So the market actually got to a point where they had so much confidence that they were paying many, many multiples more for a business than what a business may have been worth. And then you see that immediately correct after. Still not back to its average. It's still trading way above its average. But this is an opportunity to say, okay, things are going to move. If you compare that back to maybe 2008 and or the GFC time, that was probably a longer term impact during that period there. And it had more of a damaging impact across many more markets. It was funding that was really dried up. And when funding gets dried up, that's it's a longer term thing to get out of. During COVID, governments threw money at the problem. And I don't think they're in positions to do that right now.
Yeah, I think what's really interesting, if you compare two examples, but I think probably the more valuable one, if you look at 2001, which was the last major sort of traditional bubble, so not impacted by regulation, but of course the tech bubble crash. The NASDAQ 50, which at the time, of course, was the 50 largest stocks on the NASDAQ in the index. The NASDAQ 50 today, 24 years later, has still not recovered. If you bought the index, the 2001 index at that stupid bubble price, you are still underwater 24 years later, before you take into account the value of your money eroding because of inflation. Wow. But what's interesting is that the average growth of the companies in that NASDAQ 50 has been approximately 20% per annum. So you get this dislocation in times of crisis or times of opportunity, bubbles or crashes, where the fundamental underlying performance of a business dislocates from price. Now, the interesting question to work out in this particular example is, are we in a situation where the price had already dislocated? And I think Sanjee and I and Pete are probably on the view that markets had got way too expensive before the volatility kicked in. And so what we're seeing now is more a return to reasonable valuations rather than a crash. Or are we in which is the 2001 example, where valuations were insanely high, the businesses have continued to perform, but the price cratered? Or are we in a 2008 period where, in the case of 2008, of course, it was underlying economic conditions that seized up. Prices were probably unrealistic, but not as unrealistic as they've got recently. You know, P ratios were 1 standard deviation, maybe 2 above the mean, whereas now we're sort of sitting at 3 and 4 standard deviations above the mean across global markets. And so in that example, what you actually had was you had PE contraction well below average due to real world economic circumstances destroying earnings. Whereas 2001 earnings weren't destroyed. It's just that this idea of paying thousands of times for eyeballs, let alone profit, was realized to be the emperor had no clothes.
Yeah.
And I think the interesting question a little bit today, that, and Pete, maybe I'll get you to comment on this with your background, is there's probably, in my view, two really groups of companies on most markets at the moment. There is a group of companies who are really stable, successful businesses whose PEs have maybe stayed around the market average or moved a little bit higher, but not a lot. Their prices dropped 30% or whatever with the tantrums. They're buying opportunities because they're wonderful businesses that are now being discounted. And there are other businesses, wonderful or otherwise, whose PEs got insanely high. I'm talking north of 40 times, 50 times earnings, in some cases as high as 200-300 times earnings. Tesla got to 1,000 times earnings, that I'd question whether it's a wonderful business for a whole bunch of reasons. But those businesses, they have a long way to fall before anything to do with economics. You know, there's a lot of people walking around naked at the moment in those assets because historically the average long-term market PE has been about 18 to 20 times.
Yep.
So, you know, if you're trading on a PE of 200 and you want to just come back to average, you're going to lose 90% of your value, your market value, without any impact on your business. So that's the classic question to understand. Are you in a business or invested in an asset whose economics have been disrupted or not? And then secondly, are you invested in a business, if you're an investor as opposed to owning it, whose PE ratio has a long way to fall, the market sentiment has a long way to fall, not because of anything to do with tariffs, but because you were participating in one of the largest bubbles in history. And if that's the case, you're in for a world of hurt, not because you didn't pick a great asset, but because you overpaid. I mean, the equivalent of walking into Woolworths and offering them $1,000 for the Chico roll, right? It just doesn't make sense, and yet we've been doing it.
Yep.
Yeah.
Thanks, Andrew. I mean, I think that with respect to buying opportunities, the herd mentality, the fear of missing out, certainly has been prevalent, right? And so, everybody's selling, I better sell. Oh, everybody's buying, I better buy. And I once worked with a very sophisticated investor whose comment was, if the bellhop says buy BHP, I need to sell BHP. And I think to stand back from that, if a business needs to grow tenfold at constant margin to be at the market average for a valuation, I'd suggest that it's got a way to come, and that's just, I think, the laws of gravity. Yeah, you may not believe in gravity, but gravity believes in you. And I've often mused that in parts of the world we think the laws of physics and economics don't apply, but they really do, and they really always will. And from perhaps a different perspective, the joy of missing out. If you're a well-run business and your fundamentals are really unaffected, if not improved, then now's a great time, right? It really is. And, those businesses are well-placed, stable earnings, secure modes, good business models, great management. This is just, it's time. And I think, and the other reflection I have is, do nothing, compound nothing. If you find yourself, especially in early stages of business or early stages of change, now really is the time to make that decision, because the opportunity for compound versus your other near peers is actually exponential now, because they're not moving and you will have. So you've responded to a condition almost by design, not of your making, and you're producing a business response. And I think, on the counterpoint, it's something I discuss with particularly my teenage children about the joy of missing out. So if you're missing out on this, why? And what is the opportunity cost? And then what is actually the opportunity? So that's not always welcome with teenage children, that concept, I have to say. They think dad's a bit silly, but the idea of, okay, I'm not having that bright, shiny thing because my long-term strategy is to have a this or to do a that, or, I want to go on State Cup with dad, and that's going to require me to save or do these other things or forego. And certainly from how do savvy business people make decisions in those markets, they're certainly seeing so. So if my long-term ambition is to be a something, and let's say use defence by way of example, is there was already an idea that we had to kind of get on our skates, and then all of this has happened, and it can be surprising perhaps sometimes how little we've moved in a time that should be accelerating our movement. What we didn't do is that's gone. That's sunk cost. But we almost universally agreed we need to do more. We've got a condition that's accelerating the urgent necessity to do more. And then in the noise, there's this surprising confusion about where do I go? Where was the right place to head in the first place? Now, I would start with there.
And I think that's probably a good point to wrap up on. That's been such an insightful conversation. And thank you for your insights from a company perspective as well as an investor perspective, looking across, everybody. So thank you. Thank you for your time. Is there any final words that you'd like to say before we wrap up?
Yeah, if I can just leave everyone with one thought. It's more than 100 years ago since the eponymous J.P. Morgan, who of course gave in his name eventually to the bank and the railroad, famously wrote that fortunes are lost in the boom and made in the bust. And I think it's a very useful piece of advice even to today. I mean, when assets are mispriced negatively, in other words, they're cheaper than they're worth and they're great assets, what better thing is there to do than buy them? Conversely, when assets are mispriced, worth too much for what they are, when's a better thing to do and a better time to do it than now if it's selling them?
Thank you, Andrew. And with that wisdom, we might wrap up. Thank you for listening. Thank you for joining us on this episode of Tip Wealth Builders. We hope you found today's discussion insightful and inspiring. If you'd like to learn more about Tip Group, Teaminvest, or our unique investment approach, visit us at tipgroup.com.au. And don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.